This is TreppWire Week in Review for the week ending July 19th, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, amid national political turbulence and big proposals for commercial real estate regulation, we also want to dig into the implications of the latest data and major trends on the CRE markets. Today, along with an overview of macro events, we have some big stories to share from the latest July CMBS data that just rolled out. We also saw a lot of news this week that gave us some perspective on the American consumer, along with findings from the Fed Beige Book. So, Stephen, why don't you start us off?
The American labor markets, as well as the middle to working class consumers, are showing signs of stress, according to this collection of data we're going to walk through. And this comes after a long period of concern that elevated rates wouldn't be able to stave off a wage price spiral. So we've definitely transitioned away from some of the upside risks, and now it seems like risks are a little bit more skewed to the downside, at least in the near term. So this week, we had a deceptive amount of data released, and this is due in part due to the Fed Beige Book, which gives us a lot of really good regional insights into the inner workings of the local economies. We also got retail sales figures, business inventories, home builder confidence, housing starts and building permits, industrial production and capacity utilization, jobless claims, and other economic indicators. Okay, breathe. So let's start with the good news. Retail sales came in better than expected. Inventories were flat. Home builders expressed lower confidence, but they did initiate more construction starts than what had been forecast. And industrial production was better than expected, and capacity was more highly utilized. On the more negatively skewed side, the Fed Beige Book raised some issues that I think are worth walking through here, Lonnie. I want to jump straight to the highlights here, right into the regional digest, because I think this is where some of the fun comments come from. So let's start with Boston. One of the highlights that stood out was that the outlook for office properties had weakened further, and that context expected a significant increase in foreclosures in the coming 12 months. Moving over to Cleveland, one large retailer reported that lower income consumers have foregone their stores in favor of lower price point retailers. Going down to Hotlanta, rising taxes, homeowners insurance, and HOA costs have become a growing concern, especially for households with fixed incomes. And then up to the Windy City, Chicago, despite higher interest rates, many contacts said they were moving forward with capital spending projects, and that rates staying higher than they had expected earlier in the year was unlikely to affect that decision-making. So that's a nice positive. Kansas City, they talked about the cost of shelter, rent growth, and basically overall housing costs had stabilized across all major districts in the metro area for the past few months, driven by, as we've been talking about, outsized growth in the supply of newly built units coming available. So that's very encouraging that finally we're starting to see evidence of the supply side of the equation normalize rents. And then finally over to San Francisco, financial stress from elevated costs, particularly for rent, reportedly pushed families to move in together and individuals to find roommates to help pay rent. So yeah, those flex ones are earning their keep.
Yeah, it's interesting. I mean, it's nice to see a highlight from those major metros across the U.S. I think, the idea here is that each metro has its own challenges and maybe seeing some of its own form of growing into this, high inflation market. In Boston, Stephen, the outlook for office properties you mentioned weakening, they saw a really big run up when COVID was in play and there was a lot of vaccine development and a lot of stuff because there's a high concentration of those very tech-enabled medical purpose type of office buildings up there. And then they had the life science boom. But you started to see that really retreat over the last couple of months. And so you see, them predicting future foreclosures in the next 12 months. I won't go through each of these, but a lot of these are, I think, applicable beyond just those 5 or 6 markets that you talked about. When they talk about rising taxes, insurance, shelter, rent growth stabilizing, these are things we've seen across the U.S. And I know Haley teased in the intro that we're going to do a little discussion around rent control or rent stabilization nationwide that's been discussed. But before we get into that, I wanted to say, like in Kansas City, they said shelter costs have stabilized because of outsized growth of new supply in the market. And we've talked about on this podcast, Stephen, that multifamily over the last year nationally rent growth has been like 1%. We also know that that correlates to like 1.1 million new apartments being delivered during about an 18-month period in 23 and 24. Magically, economics work. When supply goes up, it does have a great impact on affordability from a housing perspective. So rent control probably isn't necessary, and we have case after case after case study that shows if you just have enough supply, pricing comes down to a more reasonable level.
I mean, this is, I guess, unfortunate. I'm even about to say this, but a lot of times with government intervention, it's too little too late. This is definitely a case where if action had started being taken maybe in 2022 and we had seen some action in 23, this would have been a more meaningful policy action. But at this point, this is any sort of intervention is simply going to skew resource allocation, distort asset prices, and in general is just not an appropriate place for government to intervene. And in my personal opinion, one thing that did stick out to me, and this is part of the Beige Book intro that I skipped over because I wanted to save it and come back for later. It's too juicy of a detail. Car repossessions are up 23% in the first half of 2024 compared with the same period last year. And this is according to data from Cox Automotive. Interest rates and car insurance, that double whammy on top of the other cumulative effects of inflation that are hitting consumers' income statements is just absolutely brutal. And in some cases, they're having to choose, what not to pay. And if we look at repossessions over a longer time period, they're still up 14% compared to the first half of 2019. And so this is definitely looks more like a new credit cycle that we've entered. And well, trajectory will continue to go up, given what we've heard from bank earnings the last week or so.
Yeah, and you know that this pressure is not abating with the job losses and unemployment figures that we've seen, steadily rising, where people that finance cars. And if you notice, like the cost of cars coming out of COVID just shot to the moon. I mean, you had people not being able to get chips and supplies to build cars. And so the supply was very low. Car prices went through the roof, and you're seeing the downstream implications of that. So I don't think we need to belabor this anymore. The reality is, consumers are being squeezed. The numbers still look fairly good from a spending standpoint, but at some point the money's going to run out. And maybe some of these early indications through repossessions on the vehicles and so forth are just kind of a glimpse into how families are starting to struggle some. And I will say, just listening to the news this week while I've been working, I don't hear any more soft landing commentary. There's a lot of people talking about recession, and we've been fortunate that we haven't seen recession. And I know at one point we were tracking the use of the word recession in earnings reports and so forth, and people were predicting 90, 100% probability of a recession that basically had abated. But it feels like over the last couple of weeks, even with the good CPI data, there's a little bit more concern that the soft landing narrative may not play out.
Yes, and one of those data points we got today was initial jobless claims and continuing claims. Initial jobless claims came in at 243,000. That's up from the previous read of 223,000 and well above the forecasted claims of 229,000. So a pretty large positive surprise to the upside. And then if we look at continuing claims, those are up as well, beating expectations. They came in at 1,867,000 versus 1.86. So again, another upside surprise on some negative data. It just feels like we are softening a little bit, and one can't help but wonder, if retail spending does continue to soften, could we see a more dramatic pullback come, say, November? I don't know. Just thinking ahead, and maybe one of our early reads will be how well Amazon did with Prime Day this year.
As we mentioned in the intro, we saw the latest July CMBS data, and that alerted us to send out several trading alerts to our clients. So these are published email alerts that get sent out throughout the day as our research team is digging through the data. And we saw 6 office updates and a hotel liquidation resulting in a loss this week. So let's give some previews from some of the data that we tracked and share some of those takeaways here today.
Sure. So the first one we'll cover is the $200 million 500 Fifth Avenue loan that was just transferred to the special servicer due to imminent maturity default. Now, this loan was set to mature in October, so we're coming right up on the beginning of that window when you will see those imminent maturity defaults open up. So according to the July servicer data, the borrower is already late on the most recent payment, although it is less than 30 days delinquent. Now, the collateral is a 727,000 square foot office building in Midtown Manhattan overlooking Bryant Park. It was built in 1931, renovated in 2012, and the property was appraised at $600 million at securitization in 2014. Here's where it gets a little bit interesting. The financial snapshot actually looks quite good. In the first quarter of 2024, the loan posted a debt service coverage ratio of 2.86 times with occupancy of 81%. In 2023, the DSCR was 3.41 times with occupancy at 85%. So the financial snapshot looks very good. Now let's run through the top tenants. If we were to run through the top 5 largest tenants of this property, W.W. Norton and Company occupies almost 15% of the space on a lease that runs through March 2039. So a fantastic amount of remaining term on that largest lease. Now, if we look through the next 4 leases, I'm going to rattle off the expiration dates here. And for context, each of these tenants ranges between 3 and 9% of the building. So the second largest tenant expires in 2035, third in 2033, fourth in 2033, and the fifth largest tenant expires in 2038. So the lease roll across the top 5 doesn't paint a picture of any sort of near-term lease expiration concern. So this servicing commentary in this loan indicates that the files are still under review and they're determining workout strategies. So one can't help but wonder, why couldn't this loan, even though it's an office loan, but with a debt service coverage of almost 3 times, and I haven't run the math, but I suspect the debt yield looks very, very good on it, why couldn't this office loan refinance? And the only thing that stood out to me is that the data also shows that there is, while it might not be the top 5 tenants, there is 14% of net rentable area that expires within the next year. And so despite the long-term leases of the 5 largest, just that level of uncertainty could mean that some debt lenders have passed on this package altogether, or the terms they're offering are less than ideal. So I wouldn't be surprised if what we see out of this loan is a potential 1-year extension and an eventual full payoff, but that the borrower is just trying to resolve that leasing uncertainty and maximize loan proceeds and get a very favorable package compared to what they could get today.
Yeah, I think you hit it on the head there, Stephen. If you're the owner here, if you think you have a plan in place to execute on this 14% potential rollover, you try to get those tenants stabilized, get extensions in place with them, and then come back to market and refi at a much better position, because you do have long-term leases in place across the top 5. If they could get this potential rollover taken care of, I think they could be in a much better place in 12 months. So this is one of those we've asked ourselves, why are we seeing so many 12-month extension options when the market broadly is not going to be that much different? This is one of those scenarios where I think a 12-month extension, if you have faith that you can secure or replace these rollover tenants, makes good sense for the operator. So this is actually a really good story in the New York office, even though right now it's not good. The reality is they're sitting at a 3+ DSCR, and supposing they get these potential rollovers taken care of, they're going to be in a really good spot with a nice long-term weighted average lease in place. So, Stephen, we're going to transition from New York over to Philly. We have a Philly office story that looks at the valuation taking a hit. This is the property at 1700 Market Street in Philadelphia. Value of the asset dropped by almost 20%. Currently valued at $199 million. Just for context, was originally valued at $244.5 million. It's a pretty large building, 850,000 square feet, built in 1968 and renovated in 2019. It's facing some challenges, which is requiring the new appraisal and thus the significant drop in valuation. Obviously, there's ongoing discussions about the loan's future on this property. So this is one that'll be top of mind for us, and you'll probably see some additional TreppWire commentary on this as it continues to play out.
All right, so let's turn over to a Kansas office loan that just transferred to the special servicer again, and this is a 2021 vintage loan. The Asperia office campus loan in Overland Park, Kansas is back with the special servicer. This is a $232.5 million loan. It's part of a 2021 deal. This loan was transferred in June due to a balloon payment default ahead of the August maturity date. Now, this is a massive 3.7 million square foot 17 building office campus built in 1998. Originally valued at $335 million in 2021, but a new appraisal in July of 23 slashed that to $183.4 million.
So that story, Stephen, is interesting because that's part of a SASB deal. So there's been a lot of discussion nationally. Wall Street Journal had a piece this week talking about the SASB market and some of the distress, even in the really secure AAA portion of those deals. So if we have time today, we're going to get into some of that. But this is one that you could, mark under that SASB heading 2021 issuance SASB deal that's definitely facing some challenges. And then we have one more story here in Houston, which is, our thoughts go out to the folks down in Houston that went without power for a week when they had a hurricane come through. It's hot enough in Houston in July with the air conditioning. I think Houston's one of the only places in the U.S. where you actually sweat while taking a shower. And even when you put the shower on cold, it's still lukewarm when the water comes out. I can only imagine being there for a week with no power. So with all the negative stuff around the hurricane, this is a mixed green story down in the Houston area. So Camden Property Trust, which is known for their multifamily portfolio, is moving their headquarters from Greenway Plaza, where they've been a tenant for about 30 years. They're moving to a new location at Williams Tower. The reason this is a mixed green is they're vacating about 86,000 square feet of Greenway Plaza, which we've detailed in great detail here on the podcast for the last year or so, and the challenges that center is facing. The upleg here, though, is that they're going to sign a larger lease, 104,000 square feet at Williams Tower, which is in the Galleria West Loop submarket. So this is, again, another blow to Greenway Plaza. It's a significant hit. Greenway Plaza, just for reference, is 4.3 million square foot mixed-use complex, has 10 buildings, parking, retail, and other properties. Occupancy at Greenway was reported at 67% as of March of 2024. And then we highlighted this in May in a TreppWire publication that the mixed-use plaza was coming to the sales market, where it's been on the market now for over 3 months. Obviously, they were hoping Camden would renew. If you're looking at this objectively, they've been there for 30 years. This is probably not a tenant that you thought was a flight risk. And unfortunately for Greenway Plaza, bad news got worse. Good news, though, for Williams Tower. They land a really stable tenant at a really good size, 100,000 plus square foot lease.
Now, to round out the office stories, we have an office portfolio over in Mountain View, California, that was sent to the special servicer. The $120 million Zapatini portfolio was sent to the special servicer, and this loan covers 10 flex office and R&D properties in Mountain View, California. And this loan defaulted at its maturity in June. Most buildings in the portfolio were constructed in the 1960s and 70s, with one of the buildings being constructed in 1990. Only one building was renovated, and that was in 2017. I mean, we're in Mountain View, California, the core hub for the R&D AI push. And so it'll be interesting to use this as kind of a barometer for exactly how much demand is out there for startups, because that's really what I feel like this campus is really well geared toward. So I see this as kind of a short-term kind of mixed bag here. Not a pure negative, but we'll just have to wait and see if this thing is able to eventually resolve and see a more positive outcome.
Now, you wonder on this one, Stephen, if this is like a property-centric issue, or if this just is some greater downward pressure from some of the business exodus and the startup exodus from the California marketplace. And so this will be a pretty good, as you mentioned, a barometer to kind of give us some perspective on that from a relative standpoint.
Now, to wrap up the trading alerts, we have one more here for you. And this is a Brooklyn, New York hotel loan sale that resulted in a loss. So the Hotel Bossert was just sold here. And this is a hotel, as I said, in Brooklyn, New York. The loan is $112 million. And it had a significant realized loss according to July data here. The loss coming in at $71.5 million. So very, very brutal loss severity on this loan. Liquidation proceeds totaled $90 million, while expenses amounted to $49.5 million. Now, this hotel is owned by the Trepp Group, which acquired it with Clipper Realty for $81 million in 2012. The partnership invested over $54 million in a complete renovation of the hotel. In 2019, a CMBS loan was arranged to facilitate Trepp's buyout of Clipper. And the value, if we were to look back in time, it was valued at $178 million in 2019. Its lowest valuation point prior to liquidation was $117 million in 2020. And the most recent value prior to liquidation was actually 129.3 million. So the liquidation proceeds were a real negative compared to what the appraisal had come in at. Now, this is a 280 key hotel built in 1909 and renovated, so you're saying, in 2019. So despite a significant CapEx spend, obviously it was just over levered, unfortunately.
And we saw a few other stories this week. Let's start with a possible conversion that might be coming for a big Park Avenue office.
Yeah, this is a pretty big one here. $670 million loan at 230 Park Avenue, which is known as the Helmsley Building. We highlighted this back in November when it was sent to special servicing. 1.4 million square foot office near Grand Central Terminal. Newsflash, exploring potential residential conversion. This could be a really cool project if it could pencil. Property was built in 1929, renovated in 2018, has 3 of the top 5 tenants' leases expiring in 2025. This property's loan matured in December, but has extension options in place that could push the final maturity out to 2026. If you look at financial performance on this asset, as of Q1 of 2024, DSCR was a paltry 0.75x, and that's with the property sitting at 83% occupancy. It was last appraised in 2021 at 1.25 billion. Where it gets interesting is there was an article this week from The Real Deal where RXR Scott Reckler was quoted as saying they're considering a conversion if it could increase revenue. He says, analyzing whether a conversion of the office building would boost revenue enough for the firm to eventually write the $670 million mortgage. They also referred in the article to some potential incentives, 35-year tax break that was passed in April for office to residential conversion. Those tax breaks reduced the tax bills by 90% for properties below 96th Street, which includes the 230 Park Avenue address. To qualify for that abatement, the office owners need to build at least 6 residential units. However, at least 25% of those units must be made affordable, which would, potentially impact the rental income. So this is one, Stephen, where, that type of incentive from the municipalities makes some of these somewhat interesting. It doesn't say here if that 90% tax reduction applies to the entire building or if it applies to the portion of the building that has been converted. But if the minimum requirement is that you have to build 6 units only and you get 90% of your entire tax bill abated, I think you're going to see a lot of 6, 7, 8, 9, 10 unit conversions, especially when you have, in this case, 1.4 million square feet to play with.
I mean, gosh, just give away some units to the staff that have to work in the building for free. That's one of the perks of the job. Absolutely. I mean, I'm looking at this building, and it would be an absolutely beautiful, iconic conversion if this was able to be pulled off. I don't want to seem greedy, but if I'm sitting in, RXR's shoes, I'd want more than a 35-year tax break, because we've seen what's happened on some of these properties that have, what initially seemed like decent term tax abatements. And for the cost that I'm just imagining would have to go into this conversion, I'd want like 40 or 50 years. I don't know. Maybe that's just me.
Well, I mean, like we saw the JP Morgan building that's being built there in Midtown where they tore the building down and they built a new one. That's been a 5+ year endeavor, and they're still not anywhere close to that actually being occupied. So, to your point, this type of conversion process is not going to happen overnight. And those 35 years start to erode, and that benefit, obviously goes away at some point too. So I do think, though, it definitely makes this potentially more viable for some of these buildings where at least one of the largest line item expenses effectively gets, backed out of the equation for a fairly long period of time. And that building, to your point, it's an iconic building. It'd be a really cool concept. I think Rexler was the one quoted as saying he had a Polaroid portfolio and an iPad world, or something, iPhone world. So it'd be interesting to see if he's able to make something of this, or if this is just, a few more talking points to just try to get to that 2026 final maturity date. A couple of other stories here. We had one, CBRE renewing their office lease in Manhattan's MetLife building. This is also on Park Avenue. They renewed their 180,000 square foot lease at the property at 200 Park Avenue. That comes just from the New York Post. They're going to continue to occupy the space through 2037 at this point. The building itself is just over 3 million square foot, which is also managed by CBRE and backs a $1.4 billion loan, which is maturing this next April. Tishman Speyer has paid $1.7 billion for the building back in 2005. So it'll be interesting to see. I mean, on a relative basis, 180,000 square feet of 3 million is not much, but it's nice for them to get a good size lease with a nice long extension to 2037 for that lease maturity.
So let's shift gears to the lodging sector. We saw an Upper Midwest hotel portfolio loan transfer to special servicing.
The $82.5 million Marriott Midwest portfolio loan was transferred to the special servicer in June due to an upcoming November maturity date. This loan backs 10 hotels across Michigan, Minnesota, and Wisconsin, totaling just a little more than 1,100 rooms. These properties were renovated in the mid-2010s. The portfolio posted a DSCR of 0.76 times in 2023. That's down from 1.08 times in 2022, with occupancy at 66%. Originally transferred for payment default in June 2020, the loan was modified in February 2022, extending its maturity date to November 2024.
This portfolio, Stephen, is one that reeks of challenge pre-COVID to me. If these hotels haven't been renovated since the mid-2010s, they were probably struggling even before COVID. They got some benefit of forbearance, et cetera, got an extension or modification in place. But the reality is, without pulling up each individual property here, I'm surmising that these properties probably had been struggling for some time, especially given their most recent financial reporting status.
Completely agree. So moving over to the West Coast, according to The Real Deal, Edward Thomas Collections has secured $400 million of fresh financing against two hotels with 327 rooms in Santa Monica, California. City Real Estate Funding originated the debt, which is being included in an upcoming CMBS conduit transaction. The financing is comprised of a $280 million senior loan and a $120 million mezzanine piece, each of which has 2-year terms. The properties are Shutters on the Beach with 198 rooms at 1 Pico Boulevard, and the 129-room Casa del Mar Hotel by the Sea at 1910 Ocean Way. The portfolio's DSCR dropped to 0.7 times in 2023 from 1.63 times in 2022, with occupancy at 69%.
It's interesting. We just had a couple of hotel stories this week, so we're not trying to paint this with a broad brush across the U.S., but, we've been saying for some time there's probably some pent-up distress in these hotels that just aren't showing broadly because RevPAR and ADRs have been boosted with travel post-COVID. But I think both of these larger portfolio deals effectively show that there are some challenges in this space, which have been, under the radar on a relative basis compared to the office sector. But, going from 1.63 DSCR in 22 to less than 1 in 23, and that's with occupancy at almost 70%, these hotels should be profitable at a 70% occupancy.
And then we saw some news in the retail segment. First off, we saw an Oregon shopping center loan resolve with a loss.
So this is a $24.9 million Grants Pass shopping center. As Haley mentioned, this was resolved with a realized loss of $5.7 million. 277,000 square foot community shopping center, which was most recently appraised at $24.3 million back in September of 2023. Liquidation proceeds on this asset totaled $28.5 million. Which you would think, oh, that's great. The loan was only $24.9 million, but there were liquidation expenses, which amounted to $11.9 million. This loan was originally scheduled to mature in July of 2017, but saw multiple extensions. So if you look at the liquidation expenses, Stephen, and on this deal, which was originally set to mature back in 2017 and continue to get extended, you can see how those fees rack up over time. And even on this deal where the proceeds were greater than the loan amount, it's still a net negative for bondholders on this particular property.
So moving over to North Carolina for our other retail story, we have a North Carolina shopping center that got an appraisal reduction, and this is not the first. And this updated value pushed the value below the loan balance. So the Alamance Crossing loan is backed by a 456,000 square foot shopping mall, and it just saw its value drop to $34.2 million, which pushes it below the outstanding balance on the loan of 37, let's round it up, we'll call it $38 million loan balance. This property was originally valued at $72.7 million in 2011, and the property's value has steadily declined over the years. The loan was transferred to the special servicer in late 2020 due to the sponsor's bankruptcy filing. The loan was scheduled to mature in July 2021. A receiver took control of the property in April 2023, and July servicing commentary suggests that it's anticipated that property will be marketed soon.
Okay, so let's move on to the banking sector. We've been seeing earnings from the largest banks come in, and I know we saw gains in the second quarter and annual revenue growth picked up. So we'll dive into some of these findings on our upcoming Market Pulse webinar. So if you're interested in attending that, send us an email to podcast@trepp.com and we'll get you on the list. But this kind of sparked a conversation for us when we saw Washington Federal Bank's earnings, and we saw some news there regarding their commercial real estate loans.
Yes. So Washington Federal Bank, or as they're abbreviated, WAFD, which I guess is WAFT, basically rehashed the execution details on a loan sale that they did. Now, this loan sale is not new news. It was announced back in May, and the due diligence period extended through June. And so the transaction actually closed toward the end of June. So I'm going to just rattle off here a line that comes direct from Washington Federal Bank's earnings from their CEO, who said, "We also executed what we believe to be the largest commercial real estate loan sale ever in U.S. banking, excluding FDIC transactions. Proving the quality and liquidity of our loans, we did it at no loss to Washington Federal. Initially, we used the net proceeds of approximately $2.6 billion to pay down $1.6 billion of borrowings, with the remainder invested overnight in our Federal Reserve account at 5.4%. Over the next several quarters, we have planned on redeploying liquidity into new loans at higher rates. In addition, and here's a fun part, we have entered into a commitment to sell with no anticipated P&L impact approximately $450 million of single-family mortgage loans. We expect that loan sale to close in late August." Now, this is very, very interesting, and something I love to see is that with so much talk about, stress or concerns in the banking sector and specifically concerns about their commercial real estate exposure, here you have a bank out there that really looks like they're playing offense at a time when it's a great time to be doing it, because what they're doing is just rotating their loan portfolio into higher yielding assets and taking care of parts of the portfolio that they don't view as maybe aligning quite as strategically with their overall game plan. One other detail I should have mentioned is that Washington Federal Bank was selling that loan portfolio to Bank of America, which I think is very, very interesting, given that this was a portfolio, something like 2,000 multifamily properties that was being liquidated. So Bank of America having such a deep expertise in modeling residential housing and basically the housing market in general, because let's remember, they for a long time were the largest single-family loan servicer in the nation. I don't know. To me, it's reassuring to see some strong hands with deep loan valuation experience here coming in on the purchase.
Yeah, and I would expect we're going to see more of this type of activity in the coming quarters. This is one that's a net positive for, it seems like, both parties involved. Hopefully there's more stories like this, and we're not talking about just non-performing loans and things being sold off at a huge discount.
And moving on to the topic of national rent control, we've spoken about this topic broadly on the podcast, but this week, President Biden put forward a national rent control proposal with which he hopes to cap annual rent increases at 5%. Let's break this down.
So yes, under the White House plan, property owners with 50 or more units would not be able to take depreciation write-offs unless they abide by the rental caps for the next 2 years. It includes an exception for new construction, as well as units that undergo substantial renovation or rehabilitation. Tenant advocates have also called for using Fannie Mae and Freddie Mac to enforce rent caps at properties encumbered by agency debt. Now, we've done a lot of work on looking at the impact of rent controls in New York City, and I would say our findings have not been encouraging for what this policy could mean for current property owners in loan distress down the road.
Yeah, so it's interesting, Stephen. A lot of advocates have called for this kind of action. I mean, this definitely makes a good political stump speech topic. But if you look at the economics and if you talk to people that are in the market, they will almost universally tell you how difficult it is to actually make this work and how it actually has the reverse impact on low-income tenants because it disproportionately hurts delinquency, property values in low-income areas. So there are a couple of quotes we're going to talk about here. Rent caps don't work and will have a chilling effect on housing supply. That was according to David Dworkin, President and CEO of National Housing Conference, which is a nonprofit coalition of affordable housing leaders. Exempting new construction will do nothing to change this, making clear that long-term investments in housing can be made uneconomic retroactively. So I think this is the part for me where it just gets a little bit of too much of a slippery slope, right? So one of the principles of our market economy is that you have property rights. And if you own property, you get to retain said rights and benefit from that from a financial perspective. And, you know, we've talked about this with some of the New York stuff when they were challenging the rent stabilization law with the Supreme Court, which ultimately to this point has proven not to work for them. The reality is this is at some level a taking of those rights, and it diverts capital from a free market economy, and it creates something other than that where the government has intervention. So just to get into some of the numbers, we reported in CRE Direct that the construction of 74,000 units got underway during the first quarter. That's according to U.S. Census Bureau data. That was down nearly 40% from a year ago and the lowest quarterly number of starts since 2019. Developers are reacting to market realities. It's becoming too costly to build. This is thanks and due to higher interest rates, construction costs. Reality is for property to pencil, rents would have to be well above market levels in many areas, and that's due to increasing land costs, cost of capital, expenses, et cetera, et cetera. So just to give some context there, overall construction costs are up 28.03% over the last 5 years. That's according to Gordian, a Greenville, South Carolina company that provides cost calculators and capital planning services to the construction industry. That overall increase was driven by a 35.5% increase in the cost of materials and almost an 18% increase in labor costs. If you look at total cost over a 10-year period, they're up over 45%. So, you know, we've had multiple discussions. We had a client symposium or CRE symposium back in May, Stephen, where we had Jay Martin come in and talk about this. Rent stabilization in New York, which restricts rents increases for multifamily complexes built between 1947 and 1973, which was strengthened back in 2019, titled the Housing Stability and Tenant Protection Act of 2019. If you look at that and the subsequent leases and renewals in wake of COVID effects, really negatively impacted that sector. And that New York market is very, very large. So it's not like we don't have sample size here. We don't have a real-time ability to actually see what the negative impacts are. Listen, I think this is a little bit of pie in the sky. It's just like every time there's an election cycle, the 1031 exchange gets discussed as being removed. I think this is something like that, although we've had several multifamily operators on our podcast as guests over the last several years, and rent regulation is definitely on their mind. And when you hear, you know, a sitting president basically saying if he's reelected, he's going to enact something like this, you can't help but think that this has negative implications for the sector.
Yeah, I mean, what really just makes me chuckle a little bit, but not a positive chuckle, is that what we know from decades of academic research, theory, and just good old economic intuition is that if you limit a landlord's ability to raise rents, they're going to underinvest in the property. So you get accelerated depreciation of the stock. That's value destruction that increases the likelihood of future loan distress on outstanding loans, and in general results in an undersupply of housing and does really achieves the opposite of what this rent regulation is intended to achieve. And so tying it to the fact that they're saying if you breach this 5% threshold, we're going to take away your depreciation I think, depreciation is, kind of a really key element for the accounting that makes some deals work or work well. So you're basically going out there with this regulation saying, if you don't know that it limits CapEx spend on multifamily properties, you're kind of silly. So I'm just going to go into the assumption that I believe a majority of these people know that underinvestment in commercial real estate is a likelihood. And then on top of that, they're saying, we're going to take away your ability to depreciate. It's basically just a slap in the face. I don't get it at all.
Let me take a slightly contrarian approach to this, Stephen. If I was arguing on the other side of the equation, a lot of these properties have Fannie Mae and Freddie Mac debt on them. And I think at some level, maybe I'm just naive, but I think at some level, these owner operators that go on social media and go online and brag about the fact that they secured long-term fixed rate Fannie or Freddie mortgages, they cash out refi, they do all this stuff. They do, bonus cost segregation, bonus depreciation. They have all this stuff in their favor. They tout the fact they're not paying any tax, et cetera, et cetera, et cetera. You're not helping yourself in my mind here, right? Especially when the charter for Fannie and Freddie is effectively create an affordable living experience for people in the U.S., whether it's through home ownership or through affordable renting. And you're kind of creating a narrative that's contra to that in a lot of people's minds. Listen, again, I'm just taking this from an argument perspective. Like, I don't discount the fact that these folks are putting their own capital, their own sweat equity into the deals. Like, you should get a return on your money. You should be able to get your money back and buy other deals. I'm not advocating against that, but I do think there is some narrative risk for a lot of these multifamily owners that have touted the benefits of those depreciation, touted the benefits of stable, secure financing through, the GSEs, et cetera, that unfortunately that narrative is maybe coming back to bite them a little bit in this regard.
Oh, absolutely. So, I mean, I'm right there with you. I'm like, some of this regulation that apartment owners don't like is due in part to some short-term disruptions, and hopefully this normalizes and the supply pressures will take care of this problem naturally, so that we can move on from this, really kind of, I view as destructive intervention.
Well, you're just dissuading investors from starting new construction projects when you do this. Like, if you're limiting the upside, and the other thing that this does is magically properties that through the free market might only be able to achieve a 2.5% rental rate increase because of just economics. Guess what their rental rate increase is now? They're pushing everything to 5%. And it's, you see this with some of the low-income housing tax credit properties and some of these subsidized properties where there's Section 8 and other things where they go to the maximum every year, which isn't provided by the market. It's just because it's some regulatory statute that allows them to go to that level. So look, if you have a different opinion on this, if you have some thoughts, feel free to share it with us. I think this is definitely one of those topics that, depending on where you sit, you may have a different perspective. And we're certainly not advocating that our perspective is right. I don't know that there is a right answer, but I do think this is one of those where more government intervention actually creates more cost and less affordable housing, which, if that's the goal, I think there's the carrot approach where you can incentivize people to place their capital, build new units, et cetera, et cetera.
Yes. I mean, and just to reiterate that point, Lonnie, as a renter of an apartment in New York City, I welcome any and all ideas for how to help the rent inflation problem. I am all for it. What I don't want to see happen is, in the long run, we do more damage than good.
Okay, and as I mentioned earlier, we have our Market Pulse webinar coming up, and that is taking place on Thursday, July 25th at 2 p.m. Eastern. We'll give a CMBS performance deep dive. We'll look at trends from some of the data we talked about today with credit stories. We'll give our Q2 bank earnings rundown and share a lot more. So send us an email and we'll get you signed up for that event. And turning to shout outs, we had some shout outs on Twitter this week. Our friend at Revan Capital quoted our data that was featured in the Wall Street Journal this week on SASB. And I know we don't have time to dig into that today, but I think we'll get to that next week. But Revan Capital was commenting on the sponsors listed on defaulted SASB loans. So we'll talk about this on a future episode. Jack Z was interested in our partnership with Blue Light Next on the mentorship program. So that is all closed out, but we did send over information and we'll be sharing more news about our partnership with them on our LinkedIn soon. My colleague Nicole and I met with Eric S., who let us know that his entire firm are huge listeners and they have listened since episode 2. So we wanted to give them a shout out and thank them for being so loyal. Anna L. was interested in signing up for our daily newsletter and future webinar events, so we got you signed up for our emails. Henry J. was interested in historical mortgage loan origination data by property type and state, so we set you up with someone on our team so we can get you that data. Andrew C. sent us some color for one of the stories that we spoke about last week. He gave us some additional information on the leasing of Vertex's renewal at Fan Pier. Brian B. noted that in some of our crabgrass stories recently, we've been talking about balloon maturity defaults. Maybe you guys can quickly define what that means, and we could also point our listeners to some resources that gives a more in-depth view.
Sure. So a balloon maturity default is just simply a loan that's defaulting when it hits its maturity date. So the term balloon just means that there is a balloon amount. So say, for instance, if it's a full-term IO, a $10 million full-term IO loan, then the borrower is going to owe, if it's a 5-year loan term, $10 million at the end of 5 years. Or say it could be a 10-year loan on a 25-year AM. So over the first 10 years, it's going to amortize on a 25-year schedule. And then the outstanding balance at the end of the 10th loan year will be the balloon amount that's due. And so instead of paying off that balloon amount in full, the loan just hits its maturity date, doesn't pay the balloon amount, and then does one of two things. Either the borrower stops making payments and it is, up kind of a hard default, or the borrower continues making the regularly scheduled monthly payments, just didn't pay off the full loan amount, and will continue paying and trying to work with the special servicer. So it can be one of those two alternatives, but all that means, that balloon maturity default means, is it's a maturity default.
And Andrew L. said he's a new listener and has really been enjoying the discussion so far. We sent him some of our past information from older episodes. Jamie A. let us know that she moved to New York City from Europe a little less than 2 years ago, and our podcast has really helped her learn about the market here in the U.S. And she was interested in some of our insurance data that we shared on a recent episode. Dave L. sent us a note saying he really enjoys and looks forward to the TreppWire podcast every week and has recommended it to a bunch of his industry buddies. So we really appreciate that. And he did ask us to speak more about retail on an upcoming podcast. So I think, Dave, we will have a special retail segment for you coming up in the next few weeks. And Keith O. sent us that same Wall Street Journal article about defaulting CMBS bonds. I know, Lonnie, you replied to that thread that we were going to talk about it. We'll get to that in a future episode. And Keith O. had some questions about AAA rated bonds and the repercussion for agencies. So we will give some color there.
So, Haley, I have a couple shout outs this week. I was lucky to tag along with one of our sales reps here at Trepp and do some in-person meetings this week with prospects and clients alike. And it's always great to get in front of people that are in the business, boots on the ground, and to hear their perspective on what's taking place in the market. And a couple of things before I get to the shout outs. One, I think we underestimate how big the CRE market is, and we kind of lose sight of the fact that the negative, the positive, all of the headlines can all simultaneously be true. And the reason I say that is, with meeting with clients this week, you have some clients whose entire thesis is based off distressed debt. And guess what? They're doing really, really well. And there's ample opportunity for them in that space to make a lot of money and do very well for themselves. And you have others that are looking for new originations and sales transaction investment sales. And guess what? Even though the transactions are slow and they're less than they have been, there's still plenty to go around for everyone in that regard too. So it's just refreshing to see how people are bringing their own perspective to the market, given where we're at in this disruption, and they're all doing, what they have to do to be successful. So Brian L., Jesse W., a lot of folks that we got to meet with this week. Appreciate you carving out some time for us, and look forward to continuing working with you guys going forward. Haley, as well, before we close, I wanted to take just a couple of seconds. I know we're a CRE podcast and we try to stick to the data, but this last weekend we had, one of those life-changing events that took place where you're probably going to remember where you were when you heard the news that someone had tried to assassinate a former president of the United States. And so we won't get into the politics, and quite frankly, that's not this is not the place for that. We're all part of the same team, and we live in the best place in the world. I mean, we have to sometimes be reminded of how blessed we actually are to be here and be able to do what we get to do, regardless of where you are in the U.S., regardless of your socioeconomic status. You're in the top 1% of the world. And so hopefully this weekend provides an opportunity for all of us individually and collectively to reflect a little bit on just how great of a place we're at and how much more great it can be if we all just come together and focus on the things that actually are important and let some of this nonsense go. So, I'm thankful that that attempt failed and that we're sitting here talking about this being a unifying opportunity for us as a country, and just hope and pray that we don't have anything else like that through the rest of this election cycle, and that we all get to do our civic duty come November and try to elect somebody that we think is going to do what they need to do to get this country back on track at whatever level and continue to be the best country in the world.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening, and stay woke.
All right.